Amazon just made one of the biggest AI announcements in the company's history. Their new AI factories, NVIDIA partnership, new Nova models, and agent building tools. So let's go through it all and what it means for their stock. Amazon dropped 4 major updates, and the first piece is AI factories. These are pre-built AI data centers that enterprises can run inside their own facilities, powered by Trainium accelerators, NVIDIA GPUs, high-speed networking, and AWS software. In practice, this turns every Fortune 500 company into a mini AWS. But Amazon still monetizes the entire compute stack behind it. It shortens AI deployment from years to weeks and locks customers into long-duration, high-value contracts. Once an AI factory is installed, nobody is ripping it out. That's recurring, predictable AWS revenue, and it's extremely sticky. The second update is NVIDIA NVLink Fusion integration. Trainium 4, Amazon's next-gen AI chip, will link directly to NVIDIA's hardware using NVLink Fusion, letting AWS build hybrid clusters that behave like one giant superchip. This reduces the compute cost per token, increases model throughput, and makes AWS one of the most efficient environments for running large-scale AI workloads. The economics here are simple. If AWS can deliver the same model performance for fewer dollars, enterprises shift more training and inference to AWS. Utilization goes up, gross margin per compute unit rises, and large customers consolidate more AI spending onto the platform. The third update is the new Nova family of models, Lite, Pro, Omni, and Sonic, plus Nova Forge. Nova Forge lets companies train and deploy their own frontier-level models directly inside Bedrock. When a company takes a Nova model, tunes it with their private data, and turns it into a company-specific frontier model, the result isn't just a one-off training run. It becomes a long-term stream of fine-tuning, retraining, and inference. Every interaction that touches that model goes through AWS, and that translates to metered, recurring, high-margin usage. And then there's Agent Core. Amazon believes the next decade will be defined by billions of AI agents quietly running inside enterprises, handling support, monitoring infrastructure, writing internal code, moderating content, automating operations. Each agent constantly hits models, storage, and databases. That is the opposite of the old burst traffic cloud era. It's always on inference. It's sticky, and it creates the kind of predictable, recurring cloud revenue that Wall Street loves. But what does this mean for the company's financials? AI factories mean Amazon shifts from selling hourly cloud compute to delivering full-stack AI infrastructure. That means bigger contracts, longer commitments, and materially higher revenue visibility. NVLink Fusion reduces compute waste and drops the cost per unit of AI work. That directly expands AWS gross margin because the same dollar of cloud spend buys more output. Nova Forge pulls model training in-house and positions Amazon as the platform where enterprises create their own frontier models. That's a multi-year workload, not a single training cycle. And Agent Core is the long tail. Millions of autonomous AI agents running 24/7 on AWS, producing constant inference requests that turn into recurring cloud revenue with almost no additional infrastructure cost. Ape is already a giant. Last quarter, it pulled in around $33 billion in revenue, growing roughly 20% year over year, with operating margins in the low to mid-30s. On a full-year basis, AWS is running at an annualized $120 to $130 billion in revenue and north of $40 billion in operating income. It's already Amazon's profit engine, but when you overlay the new AI stack on top of that, AI factories, NVLink Fusion, Nova Forge, and agents, the economics become more powerful. AI factories drive more enterprise spending. NVLink Fusion reduces compute cost and lifts margin. Nova Forge increases training volume and keeps it on AWS. Agents create persistent inference traffic that compounds over time. Realistically, over the next few years, this can push AWS revenue several billion dollars higher than the current run rate and expand AWS operating margins by 2 to 3 percentage points. Even at the conservative end, that combination reasonably adds $9 to $13 billion of extra operating profit versus a no AI factories world. At the consolidated level, Amazon today is running at roughly $70 billion in EBITDA. Add the AI uplift, and Amazon becomes a business doing high 70s to low 80s in EBITDA instead of 70. Without touching the valuation multiple, the company's earnings power steps up by 10 to 15% purely from better AWS economics. Then you layer in Trainium 4 with NVLink Fusion. This is where the economics flip. Traditionally, AWS rented NVIDIA GPUs at thin margins. But if Amazon can combine its own silicon with NVIDIA's architecture and squeeze more tokens per dollar, it runs AI clusters with better efficiency than competitors. Lower cost per token means lower cost per workload and higher utilization, therefore better margins. Showing a measurable mechanical improvement in cloud economics, and AWS is the only cloud vendor with this specific hybrid silicon advantage right now. Nova models and Nova Forge amplify that shift. When a company trains or fine-tunes a frontier-level model inside Bedrock, AWS captures compute, storage, networking, inference cycles, and future retraining. Every Novella model becomes a compounding revenue engine, and crucially, training and tuning are high-margin workloads, meaning the more Nova Forge is adopted, the more AWS's margin profile drifts upward. And then there's Agent Core, arguably the biggest long-term driver. Agents don't run once. They run constantly. They iterate. They retrieve data. They take actions. They generate responses. Each agent is essentially a persistent workload that lives inside AWS forever. If Amazon is right and enterprises eventually run millions or billions of agents, that becomes the largest recurring inference revenue stream AWS has ever had. It's like AWS reinventing SaaS, but at the infrastructure layer. This is why the financial impact matters. In the last quarter, AWS generated roughly $33 billion in revenue and just over $10 billion in operating income at about a 31% margin. But with AI factories increasing enterprise commitment, NVLink Fusion improving efficiency, Nova Forge lifting training workloads, and Agent Core increasing recurring inference, AWS can support both higher growth and higher margins at the same time. If revenue accelerates by even 4 to 6 billion annually, and margins expand from 31% into the mid-30s, the result is $9 to $13 billion of additional annual operating profit. Now let's take that uplift and translate it into valuation. At $235 a share, the market is valuing Amazon as if AWS just continues on its current trajectory, growing steadily, expanding margins gradually, and benefiting from AI in an indirect, narrative-driven sense. But when you plug in the actual economic impact of the new announcements, the earnings power steps up meaningfully. If Amazon goes from $70 billion in operating income to around $80 billion, you've essentially lifted the company's earnings base by roughly 14%. If the market keeps valuing Amazon at roughly the same multiple, and there's no reason to assume multiple compression when earnings quality improves, fair value steps up by the same magnitude. That takes the stock from 235 to around 270, and we will assume this as the base case. A bear case is simple. Maybe AI adoption is slower. Maybe enterprises take longer to deploy AI factories. Maybe agent core adoption lags expectations. In that scenario, AWS margins only inch up slightly and revenue comes in toward the lower end of the uplift. Amazon's valuation might move into the mid-240s to 250s. Not a collapse, just less upside. But the bull case is far more interesting. If AI factories become the default on-prem solution, if Nova Forge becomes the standard for enterprise model training, and if agents proliferate at the scale Amazon expects, then AWS's margins move toward the high end of that mid-30s band, while revenue growth overshoots by more than $4 to $6 billion. In that world, consolidated operating income moves into the low 80s with a cleaner margin profile. If the market rewards Amazon for driving real, measurable AI monetization. Instead of speculative narratives, the stock can justify valuation in the low 300s. From that, we can get a weighted value of the stock in the high 260s to high 270s is the most reasonable fair value from today's numbers, with a meaningful path into the 300s if AWS executes on this AI stack. So gives an upside of over 15% in the next year for the stock. Let me know what you think of this news and make sure to subscribe for more videos.